Well, welcome back. We're glad to have you back. We are starting up towards the top of page 9. Now, in the last video, we talked about exempt securities. These are securities are exempt from registration and advertising requirements, never anti-fraud, okay, because of the nature of the stuff. That's that government regulators list of charities is short. All right, but we also have exempt transactions. So what we want to do is that we want to change our focus just a little bit and keep that in mind, all right? So what I like to do when I talk about exempt transactions is to talk about when I was in production, one of my customers, he had several businesses, but where he really made the most money was that he sorted and sold sand. Yeah, the guy had very good eyes and very quick hands, it's there all day long. No, he wouldn't do that. He wouldn't do that. What he'd do is dredge it up out of the river. You have to see if you're awake, okay? He'd dredge it up out of the river, and then he'd put it into this big hopper, okay? And this hopper had two different screens on it, okay? The one up at the top was pretty big mesh, but the one down at the bottom was much smaller. Of course, he had several different sizes, but you get the idea, okay? And he'd dump all the sand in there. Well, some of the pebbles were big enough that they'd get caught in this, and they'd be over here, and basically if you had a pickup truck and some kind of currency in your pocket, you could do a deal with him. Okay, everything that could fit through there obviously was small enough to fit through, but there were some that were big enough that they got caught over here. Okay, it's much smaller, much finer, much more uniform, a little bit more expensive because like masonry sand, it just looks good if all the little pebbles are the same size. Okay, now everything else though, this is where he got his big money. Because they're very small, very uniform, very fine. He could get a premium price on this stuff selling it to sandblasting companies. Because if they had one pebble that was too big, they'd shut down a whole crew until they could break it down, clean it up. They would pay a premium price for this stuff. Now, I don't care about sand, so what let's do, let's take all securities and put them into our hopper. There are certain securities that get caught in that first screen. Those are our exempt securities. Your governmental issuers, your regulator in 1933, your charities, your short term, they're out of the loop. They're not going to go through registration. It either is or it isn't. So it's either exempt or it's non-exempt. Well, if these are exempt and we've got them all sorted out, guess what these are? Non-exempt. Man, I hate that term because exempt means does not apply. Non-exempt means that the rules with regard to registration and advertising do not apply. If the rules do not apply, then the rules do apply. Hey, I didn't write it, okay? If it was me, I'd say, as to follow skates, all right? But I didn't write the rules. Okay, these are all non-exempt securities. The thing is that there might be some extenuating circumstances. Like, for instance, these things might come to market in an exempt transaction. Now, if there's not a securities exemption, kicks it out over here, and there's not a transaction exemption that kicks it out over there, guess what you do with these? Yeah, that's where your big bucks are. Register those puppies. Okay? One guy said, how is it that you can tell the difference? And by the time that I got through, I'd drawn this. Again, it's really the best way to explain it. Because you dump them all in the hopper, some of them get out of the loop on stage one. The ones that don't, they're non-exempt. But if they get caught on that second screen, then they don't have to register because it's an exempt transaction. And other than that, you file out a registration statement. You wait the 20-day cooling off period. You get the effective date, all 9 yards, okay? So that's what we've got. So what are these transactions? Private placements, intrastate transactions are two of the big ones that you'll see. A private placement, again, they're exempt from full registration requirements only, not fraud provisions. There are certain requirements that you won't need to know it, but basically people with either institutions or individuals with substantial means or substantial income or insiders to an issue. You know, if you just restrict your offering to those folks, then it doesn't require registration. They're assumed to be sophisticated investors. Okay? Or intrastate transactions, and some folks have trouble with this, so I like to go through it every time. INTRA state means that everything happens within a state, but INTER state means that you not only have dealings here, but you also have dealings on some OTHER state. Okay? This interstate commerce is the domain of the federal government. Intrastate, everything within a state, is the domain of the state governments. So these are going to be exempt at the federal level because the states are required to take care of them if appropriate. Okay? So those are the biggies on your exempt transactions. There are a couple of others, we don't worry about them for this. Okay? All right, so anyway, registration provisions that are specific to investment companies, because investment company mutual funds in particular are kind of odd because they don't trade. So they have to issue new stuff every time. So to register as an investment company, then the entity has to have at least 40% or more of its assets in securities. Okay, that's why when we get to real estate investment trusts, and we just kind of kiss them on the cheek and go on down the road, all right? But basically, real estate investment trusts cannot be investment companies because you run out of percent. You wind up with 115% or something like that. But quite a bit more than you've got access to, because 40% or more has to be in securities. And then a clearly defined investment objective. You can't just say it's, you can have a partnership that says we're going to do the best we can, trust us, honest, we're good. But you cannot have a blind pool with an investment company. It has to have clearly defined investment objectives. Now, these provisions were set up in the Investment Company Act of 1940. In 1940, $100,000 was a ton of money, just a ton of money. And so you have to have at least $100,000 in assets or the ability to raise that within 90 days of registration. Okay. You also have to have 100 shareholders, so 1,000 per. Okay. But the ability to get 100 shareholders. But $100,000, they never have changed that. And so now, it's just chump change. And so that's why there's so many investment companies. It's so easy to do with regard to that threshold on the asset amount. And because only new securities are offered, that's what we referred to just a second ago, the fund will have a continuous registration period. All right? So you have an effective date where you can sell the securities. Once you hit that first one, tomorrow's another effective date, and the next day, the next day, the next day. It just keeps going on and on. All right? New securities cannot be purchased on margin for 30 days in general. Margin is basically a situation where I put up half, I borrow the other half. Well, I don't care if it's a bond, if it's a stock, if it's a mutual fund, it doesn't matter. I cannot buy a new security on margin for 30 days. Well, if my mutual funds are always new securities, then I can never buy them on margin. Now, after 30 days, it will have collateral value, but as far as buying it is concerned, that's where you need to read your question carefully. Okay? A lot of difference between buying on margin and having collateral value in a margin account. Okay, mutual fund shares may therefore never be purchased on margin, and they do have that collateral value after 30 days. So some of the other provisions then of the 1940 Act, open-end investment companies may only offer common shares. Now, remember that we've got that exchange going on. Okay? So what's happening is that your mutual funds or open-end investment companies, they are selling stock and getting money. Okay? This is always common stock. Now, what do they do with this money when it comes back over here? Check the prospectus. Can they buy common stock? Well, okay, then they can. Can they buy preferred stocks? Can they buy bonds? Okay. Can they buy treasuries? Can they buy Jennings? Name it, okay? Whatever's in the prospectus that they can buy, they have to have a clearly stated objective, which is going to say those are the things that we can buy. But whatever they can buy, that's what they're going to do with the money. But how do they get the money? By issuing or selling common stock. It's always common stock. Okay. Then let's see, the no margin activities are allowed by investment companies. So now, again, you can have a margin account, but your investment company cannot. Your investment company has to have an account that's fully paid. You have to have a margin account to sell securities short. Now, short selling is where I borrow something from someone else and sell it in the hopes that it is going to go down. I've been in production, I was in production for a long, long time. I did it once, okay? We actually made money on it. We sold Xerox short at, I think it was 36 and bought it back in at 28. So, like I said, we bought it at 28, sold at 36. We just did it in reverse order. That's what you have to do. But it takes a margin account. You can't do that because the investment companies have to have cash accounts. Now, they can, they cannot have uncovered option sales. Okay? It's, I don't want to open the can of worms, but you open up just a huge risk, and because of that risk, you have to have a margin account to do that. They can't have margin accounts. They cannot incur margin debt. With shareholder approval, they can incur bank debt. Now, we've got 2 or 3 things here that we need to pay attention to. One is, you gotta have shareholder approval for that. Because anytime you introduce debt, you introduce leverage. Leverage is just a fancy term for magnifying both risk and return. So, you've got to get the shareholder approval to do that. And with shareholder approval, an investment company can get 50% debt, but subject to a 300% asset coverage ratio. Here's where my artwork comes in handy, okay? Because let's say that we've got 100 million, okay? Fully paid securities and cash. We can go out, not in a margin account, but we can go out to a bank and we can borrow half of that. That's about half. There's 50, okay? Now, if that 300% asset coverage ratio was not in there, then basically what we could do is now we have 150, but only 50, we could go out and borrow another 25, 12 and a half, 6, you guys get the idea. And you know, we would approach 1-to-1 just asymptotically, as my stat professor would have said. But they say you've got to have that. So what's our total assets? 150. Okay. But what's our debt? 50 equals 3-to-1 or 300%. That's what it does, is it says you can borrow 50% once, okay, but then don't recalculate it again. But you'll need to do this. Now, let me ask you this, okay? What if we were looking at this situation? Yeah, how much more can be borrowed?
The 20 million.
The 20, that's right. So what you do is you take the unleveraged assets of 100, divide it in half, and then you take this and subtract it out. Because those 30 bullets you've already shot. You can't shoot them again, all right? That leaves you 20 in dry powder that you can use. That's a possibility for a question. All right, well, we cover that. But like I say, it really, that just simple little drawing, it'll give you your perspective. Okay. All right, capitalization then, if we do this, is described as one class of capital stock and limited bank borrowing. It's in quotes because that's the phrasing that you'll see. And so that is appropriate for an investment company, an open-end company. is one class of capital stock, common, and then limited bank borrowing, limited to the 50% 3-to-1 coverage ratios. And then joint investment or trading accounts are prohibited. What we're talking about here, let's look at, and again, I just pick on some of these companies, neither to endorse nor to make, make it look bad, just that they're well-known names. American funds, they're huge, make a big target, all right? And so American funds, how many American funds own Microsoft? Oh my gosh. There's so many, I'm not going to do the research to find out, but make me guess, I'd say probably 15, 20, 30 maybe. Guess what? When this fund needs Microsoft, it goes out and buys it on its own. When that fund needs Microsoft, it goes out and buys it on its own. It's not like American funds buys a huge block of Microsoft and says, hey guys, come and get it. No, each fund is its own trust. Each fund is its own separate business. So each fund does its own transactions. So you can't have those joint trading accounts. And that's what that refers to. Those are prohibited according to the 1940 Act. So that takes us through, like I said, a couple of the acts that we have dealing with new securities. And we'll then come back once we get to the next video, start talking about some investment analysis, some of the economic terms and risk terminology, what have you. So anyway, we'll go ahead and wrap this one up, and we'll see you then on the next video.